A bank will approve you for more house than you can actually afford. That's not a mistake, that's how the math is built. When you apply for a mortgage, a lender calculates the biggest number you're eligible to borrow, not the number that lets you keep investing, keep saving, and still sleep well at night. Those are two completely different calculations, run by two completely different parties, each optimizing for something else entirely. The bank is optimizing for what you can be trusted to repay without defaulting. You should be optimizing for what you can afford to live with for the next 30 years. Most people never separate these two numbers. They see one figure on a pre-approval letter and treat it as the answer, when it was only ever the ceiling. Today we're going to run both calculations, side by side, using one real household and today's real interest rates, so you can see exactly where the gap between approved for and actually afford comes from, and what that gap is quietly costing you. Let's keep this fair. Here's our baseline household. Combined income of $120,000 a year, $10,000 a month before taxes. Credit score of 740, solidly in the excellent tier. One existing debt, a $400 monthly car payment, nothing else on the books. A 20% down payment already saved and sitting in cash. Current market rate, 6.75% on a 30-year fixed mortgage, roughly in line with recent averages. These are the exact inputs a loan officer would plug into an automated underwriting system, no rounding, no guesswork. Using a standard debt-to-income ceiling of 45%, which is common for well-qualified conventional borrowers under most major lending programs, this household can carry up to $4,500 a month in total debt obligations. Subtract the $400 car payment, and $4,100 a month is technically available for a mortgage payment, property taxes, and insurance combined. Run that number through current rates and a standard loan structure, and the bank's pre-approval letter comes back with a purchase price of roughly $600,000. That's the number printed on the letter, in bold, at the top. Now let's find out what that number actually costs to live inside. A $600,000 pre-approval doesn't feel like a ceiling, it feels like permission. It's the number that gets you into the better school district, the renovated kitchen, the walkable neighborhood your coworkers already live in. It feels like proof that the last 10 years of work just got validated by a bank's algorithm, that you've officially arrived at the life stage where this is simply what you can have. And once the listing photos are this good, the spreadsheet quietly stops being the thing you're thinking about, the granite countertops are. Real estate agents know this. Lenders know this. The entire home buying experience is built around the emotional high point of "you're approved," not the quieter, less exciting question of what happens to your finances in year 3. None of that makes you careless, it's simply how the decision is engineered to feel from the inside. Every part of the process is designed to keep that feeling front and center. The open house is staged with fresh flowers and warm lighting, the listing copy uses words like "dream" and "forever," and the pre-approval letter itself is framed as good news, not as a ceiling with a warning label. Nobody hands you that letter and says, "This is the most the bank will risk on you, not the most you should risk on yourself." It's simply printed as an approval, and approvals feel like green lights. But feelings and math are different things, and only one of them shows up on your bank statement 5 years from now. On paper, the $600,000 home looks completely reasonable. Principal and interest on a $480,000 loan at 6.75% runs about $3,113 a month. Add estimated property tax of roughly $500 a month and homeowners insurance around $150 a month, and total housing cost lands near $3,700 a month. Against a $10,000 monthly gross income, that's 37%, comfortably inside most lender guidelines, and not far off from several popular financial rules of thumb that cap housing around a third of income. The pre-approval letter says you qualify. The online mortgage calculator says you qualify. Your loan officer, your real estate agent, and the numbers on every closing document all say this is a reasonable, responsible, well within your means decision. There's nothing on this page that looks like a warning sign. Until you subtract what nobody talks about at the closing table. Start with maintenance. Industry estimates consistently put annual upkeep at 1% to 2% of a home's value. On a $600,000 house, that's $6,000 to $12,000 a year, or roughly $500 to $1,000 a month. It almost never comes up in a pre-approval conversation because it isn't a line item on any loan document. Nobody underwrites your water heater. And maintenance isn't a smooth, predictable monthly charge either. It arrives in lumps. A furnace doesn't fail gradually, it fails on the coldest week of January, all at once, for $4,000. A roof doesn't age down to zero gracefully. It holds for 18 years and then needs full replacement for $15,000 in a single quarter. The 1% rule is an average across decades, not a bill you'll ever actually receive as 1% a month. In the real world it shows up as silence for 2 years and then a single number large enough to wipe out an emergency fund. Next, insurance volatility. That $150 a month estimate assumes today's premium, not the renewal rate after the next round of regional rate increases, which in many markets have outpaced general inflation for several years running. Homeowners in wildfire zones, flood plains, and hurricane corridors have watched premiums double inside a 5-year window, and even buyers well outside those zones have seen carriers exit entire states, forcing a scramble for replacement coverage at a higher price. The number on your pre-approval letter is a snapshot of the cheapest year you will ever pay. Every year after that, it's a question mark, and it's a question mark on auto pay. Third, the opportunity cost of the down payment itself. 20% of $600,000 is $120,000 in cash, permanently locked into home equity instead of earning a market return anywhere else. That's not a hypothetical loss, it's a choice with a price tag, and the price tag is whatever that $120,000 would have compounded into if it had gone into a brokerage account instead of a down payment. Home equity is real wealth, but it's a liquid wealth. You can't sell 4% of your kitchen to cover a medical bill. That $120,000 is now doing exactly one job, reducing your loan balance, while the same amount invested elsewhere could be doing several jobs at once, growing, generating dividends, and staying accessible if you actually needed it. Fourth, scale creep. A bigger home doesn't just cost more to buy, it costs more to live in, every single month, in ways that never appear on a mortgage calculator. Bigger square footage means bigger heating and cooling bills. More rooms mean more furniture you didn't budget for, because an empty guest room stops being acceptable the day you move in. A nicer neighborhood tends to come with a lifestyle to match it, the coffee shop, the gym, the landscaping service your neighbors all use. None of this is required by the mortgage. All of it is quietly required by the house. The home doesn't just cost what the loan says. It costs what the lifestyle around the loan ends up costing, and that number is almost always higher than the one anybody budgeted for on move-in day. Fifth, closing costs themselves, typically 2% to 5% of the purchase price, or $12,000 to $30,000 due before you've even unpacked a single box. Appraisal fees, title insurance, loan origination fees, prepaid property tax and insurance escrows, all of it lands in one lump sum at the exact moment your bank account is already at its most depleted from the down payment. It's the cost of the cost, charged once, and rarely mentioned until it's already itemized on the closing disclosure sitting in front of you with a signature line. And there's a sixth cost that compounds quietly underneath all the others, rate risk on the life you build around this payment. A fixed-rate mortgage protects the loan itself, but it doesn't protect the rest of your budget from what happens around it. Property tax reassessments after a purchase, HOA dues that increase annually, utility rates that climb with inflation. The $3,700 a month number on your approval letter is the lowest that number will ever be. Everything after closing moves in one direction. None of these 6 costs show up in the 37% debt-to-income ratio the bank calculated. Every one of them shows up in your actual bank account. Add them up and the picture changes fast. The $3,700 a month approved payment, once you layer in a realistic maintenance reserve, a more honest insurance estimate, and the ongoing drag of scale creep, quietly becomes closer to $4,400 to $4,700 a month in the years the roof or the furnace actually needs attention, pushing total housing cost from 37% of gross income toward 45% or higher in those specific years. The bank's math was never wrong, exactly. It just measured the payment on the one day it was smallest, and then let you assume that was the payment forever. Nobody signs a mortgage expecting the easy year. They sign expecting every year to look like the pre-approval letter. It never does. There's also a version of this conversation that doesn't get talked about enough. What happens to this math if income doesn't rise as planned? The entire 37% calculation assumes $10,000 a month keeps arriving, on time, indefinitely. A layoff, a slow season for a commission-based role, a medical leave, any disruption to income doesn't just strain the mortgage payment, it strains a mortgage payment that was already sized at the outer edge of what the household could carry. A homeowner at 25% of income has slack built into every single month. A homeowner at 37%, once maintenance and insurance drift upward, effectively has none. The house doesn't ask what kind of year you're having. The payment is due either way. Now compare that to the conservative path, the same household, same income, same credit score, but capping total housing costs at 25% of gross income instead of 37%. That's $2,500 a month, which supports a home closer to $385,000, a $215,000 lower purchase price, a $43,000 smaller down payment, and roughly $1,200 a month freed up in ongoing cash flow. Take that difference and invest it instead of spending it on square footage. Put the $43,000 down payment difference into the market as a lump sum, and add the $1,200 monthly difference going forward, both compounding at a conservative 8% average annual return. Let's walk through what that actually looks like year by year, because the number at the end only means something once you've watched it build. By year 3, the lump sum alone has grown past $54,000, and the monthly contributions have added roughly $47,000 on top of that. Combined, the gap is already worth more than $100,000, just 3 years after closing on 2 very similar houses. By year 5, that combined figure crosses $175,000. This is the point where the 2 households, on paper, still look similar, same jobs, similar cars, similar looking lives, but one of them now has a 6-figure account, the other doesn't. By year 10, that gap alone has grown to approximately $312,000 sitting in a brokerage account. This is also, not coincidentally, the point where the $600,000 homeowner has barely dented the loan. A 30-year mortgage is front-loaded with interest, so a decade of payments has moved comparatively little principal. The conservative buyer's mortgage is smaller to begin with and further along relative to its size. 2 households, 10 years in, same income the entire time, one has a growing investment account working independently of their job, and one has a slightly smaller mortgage balance and a house that's worth what the market says it's worth on any given day. By year 15, the compounding stops looking linear and starts looking exponential. The account is no longer growing mainly from new contributions, it's growing mainly from itself. Growth in year 15 alone can outpace the entire value of the account back in year 5. This is the part of compound interest that's easy to describe and genuinely difficult to feel until you've watched a real number do it. By year 20, it compounds to roughly $907,000. Compare that against the milestones on the other path. The $600,000 homeowner is still carrying a mortgage balance well above $350,000 at year 10, and even by year 20 is only now approaching the tail end of the loan, with no comparable investment account to offset it. Both households, 20 years later, likely still have jobs, still have cars, still look similar from the outside. One of them has a paid-down house and nothing else working for them. The other has a smaller house, a paid-down mortgage of their own, and close to $907,000 that spent 2 decades growing without requiring a single additional decision. That's not rent money, and it's not wasted money, it's the measurable, compounding distance between the house the bank approved and the wealth the conservative buyer quietly built instead. And the uncomfortable part is that from the outside, on moving day, both decisions looked identical: same income, same credit score, same lender, same rate. The entire $907,000 difference came from one number, the percentage of income each household decided to let the house consume, chosen once, and then left alone to compound for 20 years in opposite directions. Now, 25% of income might feel unrealistic in a lot of markets, and that's a fair objection, so let's split the difference and see what a middle path looks like. Cap housing at 30% instead of 25%, and the household qualifies for a home closer to $460,000, roughly $140,000 below the bank's approval and $75,000 above the ultra-conservative scenario. That frees up about $760 a month compared to the $600,000 path, plus a smaller down payment gap of roughly $28,000 up front. Run that same 8% compounding math and the 20-year gap still lands north of $570,000, smaller than the full conservative scenario, but nowhere close to zero. The lesson isn't, buy the cheapest house you can tolerate. It's that every percentage point you give back from the bank ceiling has a real, calculable price, and that price compounds whether you're paying attention to it or not. It's also worth stress testing the assumption doing the heaviest lifting in this whole comparison, the 8% return. Markets don't move in a straight line, and a decade with a recession in it won't average 8% smoothly. So run the same math at a more conservative 6% instead. The 20-year gap on the full conservative scenario drops from roughly $907,000 to closer to $650,000. That's a meaningful haircut, and the conclusion doesn't change. Even at a lower, more cautious return assumption, the gap between the house the bank approved and the house that leaves room to invest is still hundreds of thousands of dollars, 20 years out. The exact number moves with the market. The direction of the gap doesn't. None of this makes the $600,000 house a mistake, and it would be dishonest to pretend the math only points one direction. Leverage cuts both ways. A 5% appreciation on a $600,000 home is $30,000 a year in equity growth, versus $19,250 on the $385,000 home, and that gain compounds on the bank's money just as much as yours, which is the entire point of using a mortgage in the first place. A mortgage also functions as a forced savings account. Every payment builds equity you'd likely never set aside on your own with the same discipline a lender enforces automatically. There are real, meaningful tax advantages tied to mortgage interest and to long-term capital gains exclusions on a primary residence. And space, school quality, commute time, and neighborhood carry a real value that no spreadsheet fully captures, no matter how detailed. The bigger house isn't wrong. It's simply a different trade, more leverage and more lifestyle now, in exchange for less liquidity and less flexibility over the next 20 years. There's also a version of the conservative path that isn't as clean as the spreadsheet makes it look. Renting the difference, or buying smaller and investing the rest, only works if the discipline actually holds, if that freed up $1,200 a month genuinely lands in a brokerage account every single month for 20 years, instead of quietly absorbing into a slightly nicer car, a few more vacations, or just a higher cost of living that expands to meet the extra cash flow the same way it would have expanded to meet a bigger house. A mortgage payment is automatic. Run that number through current rates and a standard loan structure, and the bank's pre-approval letter comes back with a purchase price of roughly $600,000. That's the number printed on the letter, in bold, at the top. Now let's find out what that number actually costs to live inside. A $600,000 pre-approval doesn't feel like a ceiling, it feels like permission. It's the number that gets you into the better school district, the renovated kitchen, the walkable neighborhood your coworkers already live in. It feels like proof that the last 10 years of work just got validated by a bank's algorithm, that you've officially arrived at the life stage where this is simply what you can have. And once the listing photos are this good, the spreadsheet quietly stops being the thing you're thinking about, the granite countertops are. Real estate agents know this. Lenders know this. The entire home buying experience is built around the emotional high point of "you're approved," not the quieter, less exciting question of what happens to your finances in year 3. None of that makes you careless, it's simply how the decision is engineered to feel from the inside. Every part of the process is designed to keep that feeling front and center. The open house is staged with fresh flowers and warm lighting, the listing copy uses words like "dream" and "forever," and the pre-approval letter itself is framed as good news, not as a ceiling with a warning label. Nobody hands you that letter and says, "This is the most the bank will risk on you, not the most you should risk on yourself." It's simply printed as an approval, and approvals feel like green lights. But feelings and math are different things, and only one of them shows up on your bank statement 5 years from now.